In a low volatility environment, a put-debit spread is often mathematically superior to a call-credit spread for the same bearish target. Both the put-debit spread and the call-credit spread are vertical spreads used when you expect a stock to drop. However, beginners often choose the wrong one because they ignore implied volatility, IV. Your choice shouldn't just be about direction. It must be about how expensive the options are right now. Let's define the put-debit spread first. You are buying an in-the-money, IDM, put and selling an out-of-the-money, OTM, put. You pay a debit to open the trade, meaning you want the value of this spread to increase. This strategy is aggressive. Because you are a net buyer of options, you generally benefit from a spike in volatility. It mimics shorting the stock, but with defined risk caps. Conversely, the call-credit spread involves selling an IDM or at-the-money call and buying a higher OTM call for protection. You collect cash up front, known as a credit. You want the spread's value to drop to zero so you can keep that cash. This is a defensive bearish strategy. You don't necessarily need the stock to crash. You just need it to stay below your short strike. Time decay is working in your favor here. Here is the critical risk-to-reward comparison. Debit spreads usually offer a higher potential return on risk, often 1-to-1 or better. Credit spreads usually offer a lower return on risk, but a much higher probability of profit. The most important factor in your decision is implied volatility, IV. Put debit spreads are long vega, meaning they benefit if IV rises. Call credit spreads are short vega, meaning they profit faster if IV crushes. When you buy a debit spread, you are buying premium. If volatility is low, options are cheap, making the debit spread attractive. If the stock drops fast, IV usually spikes, amplifying your gains. Conversely, when you sell a credit spread, you are selling premium. You want options to be expensive when you sell them. Therefore, credit spreads are ideal when IV is already high. Let's look at the fast crash scenario. If the market tanks tomorrow, the put-debit spread wins big because it captures both the price move and the volatility expansion. The call credit spread wins too, but its profit is capped at the credit received. Now consider the slow grind scenario. If the stock slowly drifts down or stays flat, the put-debit spread might struggle because time decay, theta, is eating into your long options value. You need the move to happen before expiration. In that same slow market, the call credit spread shines. Since you are a net seller, theta decay puts money in your pocket every day the stock doesn't rally. You can be directionally wrong and still make money. So how do you decide? Use IV rank or IV percentile. This simple metric tells you if options are historically cheap or expensive relative to the stock's own past. Here is the decision matrix. If IV rank is low, under 30, buying the put-debit spread is cheaper and offers better leverage. If IV rank is high, over 50, selling the call credit spread gives you a wider buffer. Let's talk about management. With debit spreads, you generally close at 50% of max profit or when the price hits your short strike. Holding through expiration is risky due to pin risk. With credit spreads, the goal is often to buy it back for 50% of the credit received. Waiting for the last few pennies often isn't worth the gamma risk of a sudden reversal. One specific danger for call credit spreads is early assignment. If your short call goes deep IDM and it's near the ex-dividend date, you are at risk of being assigned shares. Debit spreads don't carry this same early assignment risk on the short leg unless the stock reverses hard. Mistake number 1. Selling credit spreads in low IV. You are collecting pennies in front of a steamroller. One bad move wipes out months of small gains because the premiums were too small to justify the risk. Mistake number 2. Buying put-debit spreads right after an earnings crash. Volatility is crushed immediately after the event. Even if the stock drops further, the drop in IV might decrease the value of your put option. Mistake number 3. Legging out. Beginners often close the winning leg and hope the losing leg recovers. This turns a defined risk trade into a naked position with theoretically unlimited risk. Don't do it. Here is the summary cheat sheet. Use this to orient your strategy before placing the trade. Ultimately, the best strategy depends on the market conditions, not just your directional view. If the VX is at 12, buy the debit spread. If the VX is at 30, sell the credit spread. Check IV rank first, then choose your spread.